Partnering with an investor. Look, there's a lot of ways you can get money for your business, and it really comes down to two different silos. We've got debt financing, credit lines, credit cards, loans, and then we've got this other side that a lot of entrepreneurs don't think about, which is the equity side of financing, where we can exchange some ownership or stock in our company for investment to come in, investment that doesn't have to be paid back like debt financing does. And this includes angel investing, it includes venture capital, it even includes something that's new called equity crowdfunding. And in order to tap into this, you have to know what these types of options are, how they work, which one works better for your scenario, how to put together a pitch deck, what these guys are looking for in financing, what you're going to exchange in return for the money. That's what we're going to decode today. By the end of this training, you're going to understand the formula to be able to get this. You're going to know the types of private equity financing that are out there, who to go to get the money depending on the stage of business that you're in, how to put together the pitch deck, what they're looking for, what their end goal and result is. And you're going to leave this with exactly what you need to know to be able to go and get money from private investors. We got a lot to cover today, so let's dive in. So look, there's a nice few different ways to be able to get money from private investors. Venture capitalists, angel investors, equity crowdfunding. These are the three most common ways that you're able to actually get money from private investors. So as I mentioned, as we start here, you always have to keep in mind there's two kinds of financing. Now, what we're most familiar with is what we call debt financing, where we take on debt that has to be paid back, right? We take a credit card, we get a credit line that's a revolving line of credit. They give us an interest rate. They give us a cap of what we're allowed to use on that. We can use the money, we can pay it back, we can reuse the money, or we go to like a loan with set terms. Here's the points we pay. Here's the rate we pay. Here's the amount we pay monthly and the term we have to pay back. That's all debt financing. And that's what we think about when we think about financing our business. But there's this whole other world out here of where businesses are financed. And businesses are financed through venture capitalists. They're financed through angel investors. They're financed through this newest program called equity crowdfunding. And what's nice about this is this doesn't have to have debt that has to be paid back like debt financing. And this, the other nice thing is we can actually bring in equity partners that can help us grow the business bigger and faster. As a matter of fact, a lot of the biggest companies in this world, including Amazon, have got to be as big as they are because they relied on this type of funding to be able to get them there. And we're going to decode all of these today. By the way, if you're just coming in, tell me where you're coming in from. Give me a shout out and say hello. Entrepreneurs are us. Just opened his office in downtown Dallas, Texas. Congratulations. I'm really excited for you. And Shandi's coming in from Columbia, South Carolina. Thank you very much for saying hello. And Brilliant Davis, always love having Brilliant Davis in, is coming in from Tucson, Arizona. So give me a shout out. Tell me where you're from, and I'll give you a shout out in return. Okay, so venture capitalists. Well, these guys are there to give money to expand existing businesses. So when we look at angel investors and when we look at venture capitalists, the biggest difference between the two, well, there's a lot of differences, but one of the biggest differences is where in the funding equation they come in. Now, angel investors are very often in the very beginning stages of the business. When you have a concept, when you have an idea, pre-revenue, you're not even making money in the business yet. You're not profitable. Then we have venture capitalists where you had an idea, you executed it, you built the business. The business is typically generating revenue. Sometimes it's generating profit or not, but this is usually the point where they come in where you have a proven concept. Okay, so that's the biggest difference. So when we look, for example, at Shark Tank, a lot of those guys focus on venture capital. They want a proven concept. They want sales to have occurred. They want systems to be in process. They want to see that the person already has something that the market has responded to positively. And angel investors, it's a crapshoot. They don't know. They just have an idea. It might work. It might not work. Now, venture capitalists, they'll invest if they believe a company has high growth and high risk potential. This is why you need to know this. Because when we look at banks, when we look at debt financing, they're the exact opposite. What they want is low risk. And sometimes we get mad at the big banks and say, well, you know, they're so conservative, but they're federally insured. They're required by law to be conservative. So they focus on very low risk. And businesses by default are very high risk because business turnover, business failure rates are so high. So it's hard for alternative lenders and banks and some of them to lend in a lot of situations because they want lower risk. But venture capitalists are the exact opposite. They like really high risk because high risk stuff usually has really high growth potential. They can hit absolute home runs. So they can have a lot of losses and stuff. It doesn't work. And one home run that could be a unicorn that could turn into a $1 billion or multi-$100 million company. So they're looking for fast growth companies with an exit strategy in place. They want to say, hey, what are you going to do to exit? Because remember, when we talk about private investors, they make their money when you exit, when you sell, when you go public, when you get acquired. That's typically the most common forms of exiting a business. And that's when they get paid, right? They invest money, the business grows, you sell the business for a lot of money, then they get a percentage of that money you sold it for because they get their money back. They came in and bought 10% equity in your business. Well, then whatever the business is worth when you sell it, they get that 10%. So they make their money when you sell, when you get acquired, when you go public. So they're there to help you get the business to a point where those things can happen. And they also want you to have a plan of doing that. They're not really, keen on getting into family-owned businesses where there's no plan ever for the business to go anywhere other than within the family. They want there to be an exit. That's how they get paid. And they also like fast growth because fast growth is what shows them that it's high growth. It's what shows them the market is wildly accepted that concept and that their risk may give them a very high return. So some things to get to actually focus on. And what's up? Alabama is in the house. What's up, Alabama? Texas, David Reed is in the house. Tamara, hello. Thanks for saying hello. And thanks for coming in from Syracuse, New York. I appreciate you saying hi. I appreciate everybody saying hi here. And I'm throwing you up on the screen as I said I would. So give me a shout out. Tell me where you're coming in from. Always love saying hello. So venture capitalists often look to recover their investment in 3 to 5 years. This is the normal time frame for venture capitalists. So 3 to 5 years is when they want to get their money back. If they're not getting their money back in 3 to 5 years, it's not typically something they're going to want to invest in. Okay, so they often want to own a larger piece of the company, sometimes even a controlling stake. How large of a percentage of piece that they own, if they want a controlling stake or not, it really depends on you. It depends on your management team. It depends on your experience, those kind of things. If a venture capitalist gets involved and you have a phenomenal idea and minimal experience at growing and scaling a business, well, then they may want more control of the company and a larger stake of ownership because they don't have the faith that you're able to take the concept and build it into a behemoth company like they want to see. But if they come in and you went from startup to 15, 20 million on your own, and they see you clearly understand how to manage a company, you clearly understand the systems, the processes, how to grow, how to scale, they're not going to typically want a large or owner or controlling piece because they see that you got things under control. So there's a lot of factors that determine what percentage of ownership they're going to want and whether they want a controlling stake or not. But your ability to manage the thing really in a large part comes into this. So again, I'll refer to this several times throughout, but if we think about Shark Tank, we see this all the time. We see them come in and make offers to completely buy the entire company, to buy 51%. They're like, hey, I'm only going to come in if I have a controlling stake because of these reasons. And usually the reasons are confidence reasons. I don't know if you're fully committed. I need somebody fully committed, so I'll have my team run it since you're not committed. And then sometimes they come in and want 5% stake, 2% stake, 1, 10. So there's a lot of variables here, but again, a large part of it has to do with their confidence of your ability to run the business. So a lot of benefits here. Interest rates are rising, right? Fed's already raising the interest rate, and so loans are harder to get. They're more expensive to get, and that's not an issue with venture capital funds. It's not debt you have to pay back. Your payments, your interest rate are higher because there's no money being lent to you that has to be lent back. So good alternative when we deal with inflation, when we deal with rising interest rates. Now, what are they looking for? Well, as I just mentioned, they want a strong management team. They want a team that knows how to run a business. Look, you and I both know that there's a difference between somebody being good at their craft and good at running a business, right? And we've all had experience of people that are good at one and not the other. A chef that's a phenomenal chef that sucks at running a business, running a restaurant, right? The restaurant fails. And then somebody that's a plumber, that's phenomenal plumber, maybe the best you've ever seen, but yet they just don't know how to run a business. This happens all the time because the skills to exceed in a trade or exceed in a skill set to be able to do well at a craft isn't the same as running a business. Like running a business requires a different skill set than an employee that's really good at what they do. And sometimes the employees can't make the adjustment to be able to ever properly run the business really well. And then as a result of that, the business never really takes off. It never really succeeds. So the management team and how strong the management team is, experienced the management team, this is something they want to see. They want to see a team that can actually run the business. They also want to see massive market potential. So I'll give you a perfect example. I know somebody that knows somebody, right? I'm not direct source, like third party down the line, that had an opportunity to invest in Yeti. Now, you remember Yeti, not like the big guy, Sasquatch dude that's running through the hills somewhere in some other country. I'm talking about like the coolers. Well, they sat in front of Yeti. Yeti pitched them, and they decided not to invest. And they didn't want to invest because the advice they gave Yeti was your niche market's too small. You're focusing on hunters and outdoorsmen, and that's too small of a market. Now, Yeti then took that advice from their pitches and they adopted their products to work for everybody, right? To anybody that wants to use a cooler, to all these people that do kids' sports and all these things. So they massively expanded the market. Then they brought in all of this venture capital. And as a result of that, it took off. It became massively successful. Let me give you another example. Topgolf. You've probably heard of Topgolf before. What most people don't realize is Topgolf wasn't created to be some 3-story driving range. It was none of that. What it was guys that figured out how to put a microchip in a golf ball. And they had a regular driving range. And all this microchip would do is tell them how far the ball would go. It would give the people that was driving the ball some statistics on like what the ball was doing. That's what it was. Then they went and said, we think we got something here. And they brought venture capitalists in. And venture capitalists said, golf's a pretty big market. This could be something, but let's expand outside of golfers. What if we expand to people that don't even know how to golf? And the venture capitalists came in and they took this chip concept and they made games out of it. I was at Topgolf with friends. Half of us didn't know how to golf, but they had an Angry Birds game and I could just chip the ball and it would bounce and run into knock blocks down. I'm like, yeah, Angry Birds. So again, made it into a game that almost anybody could play. They brought in the food concept. They made it multi-level. And then all of a sudden, Topgolf takes off. So it's a matter of mass market appeal. And you see this on Shark Tank all the time. They want something that can appeal to a large market because that way it can grow. It never really reaches the ceiling. And they want something that's unique, a unique product, a unique service, or a strong competitive advantage. So what I mean by that is that Yeti was not a unique product. Plenty of people had created coolers, although at the time, Yeti had, the actual patents on the technology. And I think now a lot of those patents have opened up and a lot of people can use them, but they had this patent on the technology that kept things cooler. But again, a lot of competition in the cooler market, right? A lot of competition in the golf driving range market. But again, they had strong competitive advantage. Yeah, there's a lot of driving ranges, but none of them have microchips and balls that can be programmed to create games like Topgolf did. Yeah, there's a lot of cooler companies, but ours will keep stuff cool for 2 days, whereas normal are only a half a day. So they had unique advantages, even though they were in mass markets, or a unique product that had never been seen before. Uber is an example, right? The concept of regular people using their cars to pick you up and using GPS technology through an app to organize it was a new concept. It was a new product. It was a new service. It was unique. So we see examples here on both sides. You either need to have a unique product or service, or you need to have like something in a crowded field, but a clear competitive advantage that sets you above and beyond. Like your competitive advantage can't be like, I provide better customer service. No. Like I gave you a real example of like a microchip in a golf ball that changes the way that we look at driving ranges, right? That's a competitive advantage. So they really want to see one or the other for them to actually want to invest. And Virginia's in the house, Georgia's in the house, Illinois is in the house. Thanks everybody for coming in. So what else do venture capitalists look for? Familiar industries, okay? So what they want to do is they want to actually be in an industry they know something about. They're not usually ones that just want to give you money and then, pat you on the butt and say, go for it, kid. I hope you do well with this. What they want to do is they want to actually come in and contribute their expertise to help you grow faster and scale bigger. They want to provide value, and that value help you grow, okay? And so they're looking for industries they have expertise in. So if I'm in the financial services sector, I'm not going to go get a venture capitalist that's actually, focuses on pet stores. That doesn't make any sense. Like, they might be able to help me on raising capital or talk to me about how it works and give me some advice, but they know nothing about my industry. They're not going to want to invest in the financial services industry when their experience is in pet care, right? That's where they can excel, because they can come in and buy a pet shop and say, hey, have you considered, the tubs where your pet can watch itself? And have you considered adding these highest profit margins upon checkout? They know the things to make the business worth more value. So I deal with a lot of venture capitalists in the self-storage space. And I interview them on the podcast. I say, what do you do? They say, well, we come in, we do these 5 or 7 things to make the business immediately significantly more profitable. They know how to go to a self-storage, put capital in, and then make the changes needed to double the revenues of the self-storage. So they understand these things. They don't want to go into an industry they don't know, like pet care, because they don't know anything about that. And these guys also want to own typically a larger stake in the company or a smaller stake in something that could have extreme value. Now, what's the difference between venture capital and angel investors? Well, angel investors typically invest in very early stage startup businesses. So the definition, if you look at all the financial definition sites, is angel investors are usually pre-revenue before you've ever made $1. And venture capitalists usually want to get involved well after you've actually earned money. Well, actually after you've proven concept, you're generating revenue, you're generating profits. So, and they also want bigger returns. Angel investors are fine getting smaller rates of returns. And they also put in a lot less cash. An angel investor might put $5,000 to $50,000 in. Venture capitalists might put in $500,000 to millions of dollars. So as a result, angel investors don't need to sit on your board. They don't put in a big chunk of money. They might not contribute a lot of value besides just the money they contribute. Venture capitalists are the exact opposite. They want typically a larger stake of ownership. They're putting in a lot more money. They want to be on the board of directors. They want to have some control and say in how you're running the actual business as a result of all of that. Because again, angel investors, early stage, a little bit of money. Venture capitalists, usually larger amounts of money and later stages. Now, what's equity crowdfunding? Well, this is where you basically find a funding portal, and then you can find all your investors in one place. So I've looked at a lot of books on angel investing and venture capital, and they all, one of the best books I ever read, it starts and says, look, if you want to raise capital, you need to move to Silicon Valley, California. And I'm like, well, this is a bad book. I don't want to do that. But what it's saying is that if you want to raise money, you're going to have to do a lot of pitches. And a lot of pitches historically have been done you in front of investor one by one. So you got to go and set up these investor meetings and you got to pitch. Nowadays, a lot of things has changed. Even if you're not using equity crowdfunding, you could put together a landing page and a video. One of my buddies raised capital that way. You go to his page and it's a page with a video. You type in the password, you can see the video, and he walks you through. His whole pitch deck is all a video. And you can have an opportunity to click and say, yeah, I'm interested in investing. I want to talk more. So nowadays, technology's changed a lot of that. Zoom gives you the opportunity to pitch without going places. It's better for the investors. It's better for you. They can see more people. You don't have to travel to get to them. They can be more diverse and look for people around the country instead of one local area. But equity crowdfunding has also changed a lot of this. What equity crowdfunding does is it's like normal crowdfunding sites, and a crowdfunding site like Kickfurther or Indiegogo that's not equity crowdfunding. That's what we call rewards-based crowdfunding. So if we look at a Kickstarter of the world, Kickstarter is the platform in the middle. They have backers that have money. They have project people that actually post projects, and their job is to have the project people a place to post their projects for the backers to see it and want to back that. That's how equity crowdfunding works. So an equity crowdfunding site like Crowdfunder goes and gets the angel investors and venture capitalists they all are the backers or investors, then you can post your project in one place. Then all these backers and all these investors see that, and they can decide if they want to invest. So it just simplifies this process of being able to raise equity. Now, you've got to be 18 years or older to be part of equity crowdfunding, and you basically are raising cash through the sale of securities, equity, debt, revenue share, and more. So what's popular about equity crowdfunding is you don't have to be an accredited investor. Okay, an accredited investor is somebody that typically has like a $250,000 in income or $1 million of net worth. And if you don't meet that requirement, you can't even go through the process of being accredited. But now equity crowdfunding is open for non-accredited investors. Like you and I can contribute as little as $50 in some cases and be part of like raising money for other businesses and get a very small return. Or we could put in $500 or $1,000. So regular people can invest into businesses through equity crowdfunding. And then the crowdfunding platform pools together money from multiple people and funds the project, not usually just 1, 2, or 3 investors. So it doesn't matter which of these you go with, equity crowdfunding, angel investing, and venture capital. One thing is common. You're going to have a pitch deck, okay? Because the pitch deck is going to be what gives you the first impression. It's a PowerPoint presentation that outlines the essentials that an investor is going to want to know for them to determine like if this is the right fit for them. So what's the goal of the pitch deck? Well, it's really not to get the funding. It's really to get you to the meeting with the investor. It's for the investor to go, oh, yeah, I love this concept. Yeah, I like it. All of it looks good. All of it sounds good. I want to meet with you, the person that owns the company, to talk to you more. I have some special questions, unique questions. It's for these investors to rule out what's not a good fit and then to say, yeah, this could be a good fit for me. It might be something I want to invest in, and get them to want to take a next step. So very important. D'Angelo from Georgia is in the house. Hello, coming in from Illinois. Steve Rivas, always love having you here. Okay, and we've got Braxton in the house. What's up? And Carcel, what's the rest? What do you mean, what's the rest? So if you mean, clarify that question, I can be able to answer that for you. Okay, so what's included in a pitch deck? Well, some creative leeway, okay? Not to say that you have to follow this formula. And by the way, from Uber to Airbnb to all the biggest companies that are out there, the unicorns, they call them something beyond unicorns now. All of these guys out there, you can find their pitch decks online. I could just Google Uber pitch deck and I can pull it up. And by the way, it's pretty interesting when you do, because you'll see that a lot of times the way they start pitching isn't what their company becomes. So if you ever look at Uber's initial pitch deck, it had nothing to do with people renting their own cars out. As a matter of fact, what most don't even know is that Lyft created that concept, not Uber. Uber's initial concept was a black car service, an app where you could call a limousine a town car whenever you went to big, highly populated cities. Then Lyft came out with using everybody's everyday cars to be able to expand the service. Then Uber adopted that. And you know that if you look at these pitch decks. So I think it's really interesting to look at some of the pitch decks of some of the biggest companies out there just to see how they started and how they morphed their model into what you see today. Now, these are the things you probably should include that are pretty common in pitch decks. One of them includes a company overview. You know, all these should be 1 slide, 2 slides max, 3, 4, 5 different bullet summary. You know, what the company is, what you do, and how you do it, why you do it. What's your company about? What do you stand for? Like, what is it you're trying to accomplish? What is the problem that you really solve? Okay, now your mission statement or your vision statement for the business. Like, what mission do you serve? What's the vision? What are you trying to accomplish? Clear, concise statement. Like, what you want it to become. Like, what you're trying to actually be to the world so they can get clarity on your vision. Now, by the way, your overview, your mission statement, these kind of things are very important, because usually if you talk to investors within the first minute, they know if it's something that they're interested in or not. So having a clear vision, having a clear mission, telling them clearly this is what we're here to accomplish is very important for investors to even know if they want to continue to listen more. Now, the other thing is your people. Okay, you want to introduce yourself. You want to introduce your management team. You want to include pictures and names if it makes sense. Okay, and again, what this section is depends on your team. If you've got a bunch of high-level name people with really deep resumes, well, you want to show that in this section. Again, they're looking for management teams that know how to manage. So you want to put that in. If you have whatever is unique about your people, you want to mention. So at Credit Suite, Megan and I run the business, right? We're the owners of the business. But the reality is we're not really well-known people that are like gurus and the venture capitalists go, yeah, Ty Credo, that guy is. So we come in and we do say a little bit about our experience and our knowledge, but we also reference our turnover, how many team members we have, how low our turnover is, because it's really unique. Like our turnover is really, 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 really low. Very few people leave the company. And that tells investors that, hey, we have a really solid culture. When people get hired here, they don't want to leave. That's something unique about our people that we want to point out in a pitch deck. Now, it's important to know that, again, you don't want to come in and like introduce every person on your team. That's not what it's about. You want to figure out what's unique about your team that gives them confidence that your management team can manage. And like I said, in our case, what's unique is the fact that we actually have very low turnover. So we want to point that out when we talk about your people. Okay, the need for business like ours. This is basically the problem. Like, what is a problem inside? What problem are we trying to solve? So we want to address that as well. Like, what's the problem that we're looking to solve? And by the way, I'm not sure if I'll mention this later, but how big is the market of people that have that problem? So how big is the market of people that actually have that problem? And I'm actually thinking right now that I'm going to come in here and maybe even show you a little bit about our own pitch deck whenever we're talking to venture capitalists, that even if I don't show it to them, I use it as a guide when I'm actually in these conversations. So I'll kind of pull that up and show you here today too. Okay, so what is your product? What is your product? What does it do? What makes it unique? How is it different? Okay, so again, this is where you show your product and service, how it's unique or how it beats the competition and why it stands out. Again, as I mentioned, what's the market? How big is the market? How many people can you serve? How big can you grow? This becomes, again, very important because they want to know that you've got a mass market. If you're not appealing to a mass market, then they're probably not going to want to invest. The other thing here is, do you already have customers? Is it working? And again, we see this on Shark Tank. Mr. Wonderful almost always asks this, like, hey, like, are you making sales now? How are you getting customers? They want to know, hey, do you already have customers? Like, is it working? What's your retention? Are you retaining the customers? Are they giving you reviews? Yeah, we've helped 50,000 customers. And, here's some of our testimonials. Bam, 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 bam. And all of a sudden you start showing mass testimonials to show that not only have we served a lot of customers, we've proven the market because we have a lot of customers. And on top of having a lot of customers, we also have come in and got hundreds and hundreds of reviews from them. And again, that shows that the concept is proven, that people, that there's an audience for it and that the audience likes it. What's our technology? Is there something proprietary that we have technology-wise? What technology do we use to actually grow the business? These are things that are important as well. So some might say, hey, what are you actually using? What are you actually using, CRM wise? And you say Infusionsoft. And they're like, yeah, you're not developed enough. When you're with Salesforce, let us know. So the technology you're owning, the technology that you own that's unique to you, trademarks, proprietary rights, anything like that, they want to know about, especially if you have specs, if you have, patents in place, these kind of things as well. How you're going to handle competition. Who are your competitors? Believe it or not, they do not want you to say that you don't have competitors because everybody does. They want you to say, these are my closest competitors. And again, this is what makes me different. This is why we're a better option than those competitors. Okay. Also, they want to see previous success. Do you have early sales? Do you have website traffic? Do you have app downloads? What do you have to prove that what you're actually going to sell is going to work, not just a concept? A lot of investors don't want to invest in a concept unless it's angel investors and it's a pretty sound concept. They want to see proof of adoption. They want to see sales. They want to see that the market is responding to what you have. to prove the demand, growth metrics, partnerships, praise from the press, anything you have that shows previous success, testimonials can work here as well. What is your business model? How do you make money? Are you 15% because you offer financing from customers and 80% from software sales and 5% from this? What does it look like? On our pitch deck, we say this percent comes from sales. This percent comes from subscription revenue. This percent comes from this, comes from that. So they want to know what your business model is, how you actually make money. How do you get customers? What's your marketing plans? I remember seeing Mark Cuban once on Shark Tank where they said, how do you get customers? And the guy said, Facebook. And Mark said, I'm out. He said, you need to have a more diverse marketing plan because if something that happens at Facebook doesn't work, then your whole business crashes. So with us, this is why we diversify. We get customers from Bing, from Google, from Facebook, from all these different places. So it shows them, the potential investors for us, that we've got a diversified marketing plan, that even if Facebook collapsed today, and even if Google collapsed today, we still are getting customers from enough other places we could move ad spend to still keep chugging along. So they want to see what your marketing plan is. How do you plan on acquiring customers? What's your cost to acquire a customer? What's the lifetime value of the customer? Okay, they want to know like that you've got a pretty good plan to be able to grow and scale the business. Their goal is to exit in 3 to 5 years. The more of this you have vetted and already mapped out, then the more comfortable they're going to feel. Also, financials, right? What are the financials? So again, they're going to want to look and see what your financial projections are. What do you project financially? What have you done in the last year? What have you done in the last 3 years? What have you done in the last 5 years? Okay. So they want to see completed financials as well. And then of course they're going to want, they know that a lot of it's based on assumptions, but that's why they're going to want to see what you've done besides just what you think you're going to do. And then the ask, like, what are you really going to be asking for example? What is it that you're actually going to be asking for? How much money do you want? How much equity are you willing to give up? This becomes very important as well. Now, tips, make it visually interesting, make it easy. Don't put a date on it as well. Make it short. Don't underestimate competition. Keep acronyms to a minimum. Don't speak in language that they don't understand. Okay, all these things become very important for you to be able to raise capital. So just to kind of give you a quick overview here, to kind of give you some of these and see it from our perspective, you can see that our stuff is very simple and it's very visually appealing, right? We help businesses get capital by doing these 3 things: building business credit, financing, fundability as well, right? We come in and we talk about actual testimonials. So here's about results, and here's the kind of credit that people are able to get, right? So we're able to show them that as well, right? We're able to show them growth trajectory. We're able to come in and talk about credit. So, hey, we're on the Inc. 5000 and, BBB rated, and we've helped this many businesses, and we have, this many reviews. So we're able to come in and show them a lot of that insight as well. Hey, here's the problem. Let's talk about the problem. 82 to small businesses failures are due to cash flow issues. And this comes from SBA. We're actually referencing where all these stats are coming from and giving them relative information to show them how deep the problem is that we solve, right? Here's what keeps our customers up at night, in their own words. They love that. Here's the problem. They're describing the problem that we're actually going to be looking at solving, right? And again, here we go. More statistics that support that there's a problem there that has to be solved, right? Here's the size of the market. According to SBA, March 2020, this is how many small businesses are in the United States, and a small business is defined this way. And according to Yahoo, this many new businesses are started every month. So again, graphically appealing, not a lot of data, just shows that there absolutely is what there absolutely is demand. Hey, what makes us different? What do we do that separates us and makes us unique in the market? Why we are unique. We're the only ones that do these kind of things. Who's running the company? What's our expertise here? And then we'll even show them like a chart here of our team leads to show how many teams we have and how many people are under each team. For example, we have 1-page plan where we'll show them, what we're working on goal wise here. We talk about our customers, who is our customer avatar? Who is it that we actually come in and service? And again, we talk about more results. We have actual video testimonials that play that we actually show them as well. We talk about how we make money, what our business model is, how we get new customers, how many customers we get, how we're diversified, what we're using the investment for, etc., projected growth potential. So again, this is what it looks like in a real pitch deck very simple, visually appealing, very little information on each slide. We just hit every one of these areas. Here's the problem. Here's how we solve it. Here's why we're unique. Here's a little bit about our team. All these things you put together, that's kind of what the final result looks like. So look, partnering with Investo can be very helpful. And there's a lot of options here with angel investors, equity crowdfunding, and venture capitalists. You just need a winning pitch deck to be able to put it together. And we also even have training on YouTube to be able to put together a pitch deck with even more insight. So if you go to youtube.com/Credit Suite and just type in pitch deck, we'll map out much more detail exactly what should be on each slide of a pitch deck. And if we can ever help you along the way with getting financing, let us know. We have some access to angel investing networks we can get you set up with. We can also talk about all kinds of debt financing as well. And again, we'll do a finance assessment at no cost. We'll help you improve your fundability, talk to you about all the sources that will give you funding now, talk to you about a game plan, a map to be able to build your business credit so you can get the funding that you need for your business as well. So things to keep in mind. And hello, and let me see here. I got Tampa, Florida's in the house. What? Like, we're next door. I could probably see you from here, wherever you are. I could probably see you out here. You might be on the cruise ship that's in the port there. I don't know, but hello. Thanks for coming in from Tampa. Thanks everybody for saying hello. And Miche says, question, sort of off topic. What if you have a holding company and do business in different industries? How would you choose it in the ICS? I would use something along the line of consulting. Find something in that consulting type space. That's probably one of the easiest industries that kind of oversee a lot or kind of, you can have an umbrella company with many different types of ones in there. And Steve is saying, hey, what's up, Steve? Always love you saying hello. Steve says, hey, great stuff as always, ties. Value is the key. Sell equity to an investor who contributes more than just cash to help the business succeed. And the investor seeks to invest in a long-term profitable venture. I love this. As Steve says, and a lot of the guys see on Shark Tank, when they're really trying to sell somebody, they're like, we're worth more than just money. We have all the connections too. And they always try to sell them on the value that they contribute. Steve's very right here. Like, you want to get with somebody that can contribute more than just money, but value to help the business grow. That's when you really can find the best kind of equity partner. So if you got value, make sure you hit the like button, make sure you subscribe, and make sure you go to creditsuite.com at the top right of our pages and take 1 minute to subscribe on other channels. We have daily tips on Facebook and Twitter. We have 1-minute videos on Insta and on TikTok. We've got hundreds of podcasts on our podcast, The Business Credit Financing Show, with 500,000 downloads. We've got thousands of videos on YouTube. With all these channels, we have a lot of different ways you can absorb information that's all designed to do one thing, which is help you get the money you need to grow your business. So thanks for tuning in. I look forward to seeing you next time, where we talk about more cool ways to get the money you need to start and grow your business.